The Fed just cut interest rates to 4%, 4.25%. And guess what? President Trump apparently has a good portfolio for these cuts. In this video, I'll break it down for you. First, what today's decision actually means for your money and daily life. Second, what Trump is doing that can help him profit from the cuts. And finally, how you can use the same playbook to grow your wealth. If you're serious about making money in this new environment, pay attention. Oh, and before we dive in, hit that subscribe button. It's free and it keeps you ahead of the curve. Let's get started. So, first, why did the Fed cut interest rates and what does this mean in practice? One thing many people were talking about this month while speculating on rates was inflation. Because inflation has accelerated again. And well, interest rates usually serve to control inflation, right? So why did the Fed decide to cut them again? The truth is, it's not that simple. It's not a zero-sum game. And the Fed seems to be balancing several things at once. Also, the dollar is weakening, and that's both good and bad. A weaker dollar makes U.S. exports more competitive abroad, which can boost American manufacturers and farmers selling overseas. It also lifts the profits of big multinational companies when they convert foreign earnings back into dollars, something Wall Street usually cheers. But for consumers, it bites. Imported goods, raw materials, and even travel abroad all become more expensive. A weaker dollar can also feed back into inflation since the U.S. imports so much of what it consumes. So while exporters smile, households may feel the squeeze. It's really hard to be a Fed right now. I would hate it because think about it. On one side, yes, prices are still running hot. Core inflation, especially in housing and services, hasn't cooled the way policymakers hoped. Tariffs on imports have added fuel, making goods more expensive across the board. Normally, you'd expect the Fed to keep rates high to squeeze that out of the system. But on the other side, the job market is flashing warning signs. Unemployment has climbed past 4.3%. Job creation in August barely hit 22,000, and earlier months were revised downward. That means the labor market is weaker than it looked at first glance. In plain terms, fewer people are getting hired, more people are struggling to find work, and companies are pulling back. Add to this the pressure on financial markets and businesses. With rates high for so long, credit has gotten tighter, borrowing costs heavier, and growth slower. Cutting rates is the Fed's way of injecting some oxygen into an economy that's showing cracks, even if it means tolerating a bit more inflation risk in the short term. So it's not about choosing inflation or jobs, it's about trying to keep both from breaking at the same time. The Fed is betting that a small cut now can support employment and growth without letting inflation spiral out of control. It's a delicate balancing act, and the outcome will depend a lot on how consumers, businesses, and markets react in the months ahead. And there's another layer to this decision that nobody can ignore: the political pressure. President Trump has been vocal for months about wanting lower rates. He argues that high borrowing costs are choking growth, hurting American businesses, and making the U.S. less competitive globally. In his words, if other countries can borrow cheaper money to fuel their economies, why should America be stuck paying more? Behind the scenes, this kind of pressure matters. The Fed is supposed to be independent, but markets know politics always looms large. Every time Trump talks about jobs, growth, or the stock market, he's also sending a signal. Lower rates give him a stronger economy to campaign on. A booming stock market, easier credit, and happier consumers translate directly into political capital. And there's no right or wrong in this story. All you need to understand is that if the Fed raises and keeps interest rates high at any cost, it will hurt the economy, but if they cut too much, it will also hurt the economy. So precision here needs to be surgical. Now, what Trump is doing that can help him profit from the cuts? First of all, I'm not implying that Trump is doing this deliberately, so please don't take it that way. Trump is a very wealthy man. He probably has a good consulting firm behind his money, and there are obviously good lessons we can learn from his portfolio. Maybe he's not even applying this strategy himself. Maybe he's just buying bonds. I think everyone should have bonds in their portfolio anyway. By the way, getting off topic, I discovered that Nancy Pelosi, the politician, has a portfolio that yields much more than the S&P 500, and people are following it. I'm thinking about making a video about it. If you'd like, comment below. But well, let's take a look at what we know about Trump's portfolio. In 2024, Trump reported more than $600 million in income from cryptocurrencies, golf golf properties, licensing, and other ventures. It also showed the president's push into crypto had added substantially to his wealth. This shows that he diversifies a lot, which I always tell you is essential and a great strategy. But what caught my attention in Trump's portfolio was his significant bond purchases since the inauguration. He bought more than $100 million in bonds. And why is this interesting? Because buying bonds before a rate cut is one of the smartest moves you can make. Here's why. When interest rates are high, newly issued bonds pay attractive yields. But the moment the Fed cuts rates, those same bonds you bought earlier instantly become more valuable. Why? Because now they're paying more interest than new bonds on the market. It's the basic principle of bond pricing. When rates fall, bond prices rise. Investors chasing yield will bid up the price of older bonds that still pay higher coupons. That means Trump's $100 million in bond purchases could appreciate significantly just because the Fed decided to cut. And there's a double benefit. Not only does he collect the steady interest payments, the coupon, but he also positions himself for potential capital gains if he decides to sell those bonds at higher prices. It's almost like locking in a fixed rent contract right before landlord/rents in a city. Suddenly, your deal looks amazing compared to what's available on the market, and people are willing to pay more to have it. This is exactly the kind of positioning that separates professional portfolios from casual investors. It's not just about owning assets, it's about owning the right assets at the right time. And moving to the third part of this video, can you do the same? Is it worth it already? What should you do? Well, it's worth remembering that Trump has been buying bonds for a while now, and he caught times where the rate was likely to rise or stay high. Theoretically, he bought at the best time. But does it still make sense to buy? I'm here with the Fed rate chart open to show that in the last 25 years, rates have been below 5% more than above 5%. What does this mean? It means that historically, we've spent much more time living in a low-rate world than in a high-rate one. But will this trend continue? That's the million-dollar question. If we look back at the last 25 years, the big picture is clear. The world has been living in a low-rate regime. After the dot-com bust, after the 2008 crisis, even after the pandemic, the Fed pushed rates close to zero for long stretches. The new normal has been cheap money. But here's the catch. The 2020s are different. Inflation came back in a way we hadn't seen in 40 years. Supply chains, demographics, energy transitions, and geopolitical conflicts are all adding long-term cost pressures. And because of that, many economists believe we've left behind the era of ultra-low interest rates. That doesn't mean we'll see double-digit rates like in the 1980s, but it does suggest the next 10 years may look more like a mid-range world, not 0%, not 10%, but somewhere between 3% and 5%. Even considering this, I think the strategy could still be a reasonable one. Think of it this way. The current Fed funds rate is around 4.25%, but Treasury bonds are paying around 4.5%, 4.7%. What we'll consider here is, if bond yields fall to 3%, which is a possible scenario, how much would you gain from this strategy? If you put $100,000 into 10-year Treasury bonds today at 4.5% yield, you'd be earning about $4,500 per year in interest. Now imagine that in a year or two, the Fed keeps cutting and new 10-year bonds only pay 3%. Using proper bond pricing calculations that account for the present value of all future cash flows, your original bond would be worth approximately $112,700 on the market. In other words, you'd be sitting on a $12,700 gain, about 12.7% return, plus the interest you've already collected along the way. Even if it takes 2 years for rates to fall to 3.5%, that's still about 3.9% per year annualized return from capital gains alone, plus your annual $4,500 coupon payments. And these projections are in line with the Fed's because they estimate that interest rates will reach 3% by 2027. Of course, I'll make it clear here that this isn't for the faint of heart because rates could rise and your bond might actually lose value. And that's fine, it will still yield, but much less than it could in the S&P 500, for example. That's why I, Trump, and any good investor diversify. Well, that's it, cousins. Stay invested.